Welcome to How I Built This, a marijuana business daily program that explores with cannabis industry executives how they built their cannabis companies. My name is Omar Shachir Bey. I'm a reporter with Marijuana Business Daily and your host today. Our guest is Nicholas Vita, CEO of multi-state operator Columbia Care. Nicholas had very successful careers at Goldman Sachs and in healthcare investing before joining or co-founding Columbia Care in 2012, and soon after, he became CEO. Today, Columbia Care is operational or has licenses in 11 states, Washington, D.C., and the European Union. Welcome, Nick, and thanks for being here today.
Thank you, Omar. We're actually in 18 states now.
No kidding, 18 states. Wow, let me, good to know, good to know. Okay.
Yeah.
18 states, Washington, D.C., and the European Union.
Well, including D.C., but I've got the scars on my back to prove it. So I think I just wanted
Got it. Excellent. Well, thanks for that. Thanks for that update.
Sure.
Well, let's, one of the questions I wanted to start with is, what got you into the cannabis industry, why you decided to jump in, and also why you chose Washington, D.C. As the place to start.
Sure. Well, it was interesting. The cannabis industry back in 2012, 2011 was something of a novelty. There were a lot of discussions happening. You saw what was going on in California and Colorado, but you really didn't see much else throughout the rest of the country. When the opportunity came up to sort of participate in the Washington, D.C. program, it was a really unusual environment because obviously at that point you had a fairly sort of draconian federal position. None of the legislative changes from Congress had been enacted, and none of the changes at the DOJ had been enacted. So you were sort of hiding in plain sight, if you will. And what we liked about the DC opportunity and the DC market was that very well defined. It was medically oriented. There were sort of a number of rules and regulations that had been developed around the sort of the federal sensitivities. And ultimately, our view was that this would be an incredibly political industry, and an industry that either succeeded or failed based in politics. So our view was to create almost a petri dish, if you will, that allowed us to build a fully integrated business model. And we were the only ones at the time that were actually dispensing in an environment where we had rules and sort of regulations, and an environment where we were actually serving the very constituency that was creating the laws that ultimately would either determine our fate.
Mm-hmm. Got it. That's really interesting. And how did that, did things pan out that way? Did the DC market evolve the way that you guys expected? And also, if I recall, I suspect you'll touch on this as you get into your answer, but it was sort of a bumpy beginning, if I recall.
Yeah, but I'd say, almost everything is a bumpy beginning. And I think that I'd love to meet the person who starts a company who says it was just smooth sailing from day one. But, everything from some of the people that we had brought on board to help us think through the business model, who turned out to be a little bit less than ethical, to the regulators who encouraged us to open up as quickly as possible. And then they realized after we had opened that they didn't have the ability to actually process the applications for people to enroll in the program. So DC had this funny requirement where once you were licensed, you had to be open 40 hours a week. And so we were open, we actually had products on the shelves, but we had no patients to serve, and no one was allowed in our building except for the inspectors. So we would have, weekly inspectors twice a week. That was the sort of the ongoing joke. There would always be somebody from, from one of the federal agencies there, Joe Smith from XYZ, who would always accompany a member of the Department of Health just to see what was going on. But it was a really interesting period of time. And I sometimes you have to be able to kind of see the long-term opportunity. But in this case, the fact that, we realized so quickly that there were so many challenges that had never been dealt with before. There was no domain expertise. There were no experts. And so my positioning from the first employee to the CEO wasn't really saying much because there weren't any other employees at the time.
Yeah.
But when I took the role, the first thing we did is we actually looked at a wall that had, we actually built our first dispensary in an old Curves. I don't know if you remember that. It's a gym, a female gym. So we had this one wall where there used to be a bunch of mirrors, and we just drew out in 3 Gantt charts the legislation, the law, and the regulations, and then our business plan. And we tried to figure out where the connection points are. And we realized very quickly that whether you're building Lincoln Logs or Lego, if the vision, if you knew what you wanted to build, you could get there, but you had to make sure you had the right pieces. And so we had to do a lot of reverse engineering to get to that point. But ultimately, we were the first dispensary open in DC.
Yeah.
We were the first fully integrated operator in DC, and we were able to leverage that experience into a know-how that was interesting and very formative in the way we thought about the DC market and how we would approach it, because all of
Yeah.
the assumptions we had made and all the assumptions we had been given were actually not just incorrect, they were actually 180 degrees from where they probably ended up being.
Yeah, yeah. Now, one of the things that if I recall correctly, when you were recollecting that experience previously, you had mentioned that the lesson learned, perhaps it's not so much important to be first to market, but to be ready to market. And does that still hold true today, you feel?
Absolutely, absolutely. We see that, and it's especially interesting because as new markets have introduced legislation and regulations and actually gone from kind of the theoretical to the active, being first in a new market is often a money losing proposition
Mhm.
because you have to wait for the market to develop. Imagine you're building a product and building an infrastructure for a consumption base that actually doesn't exist in a regulated form. So that rush to be first, I think, is something that we quickly grew out of, and we realized that it was actually better to be prepared, as you said, and especially when you think about the number of markets that are now transitioning either from no program to a medical program or from a medical program to adult use. You see what has happened in markets like Massachusetts and Illinois when this transition occurs, and people are prepared for that transition. They're able to really capitalize and sort of use that purpose-built infrastructure and really train their personnel so that the experience from a consumer's perspective is seamless. And
Yeah.
that's the sort of thing that I think you acquire over time, and
Mhm.
frankly, by making mistakes.
Got it. And just to give our listeners some context, when the DC dispensary was opening up and you were going through this is what, 2013, 2015, something like that?
It's 2013.
2013. Wow.
Yeah.
Okay. So a while ago. Now, uh, you all, you've discussed in the past some of the steps that you took to improve the situation in DC, and I think one of them was getting customer feedback
Hmm.
at that time. Tell us at that time, again, with the industry being so young, DC, a new market, it's a new industry. How did you guys go about, number one, figuring out, okay, we got to get, customer feedback, and two, sort of implementing and executing, and how has that process evolved for Columbia Care, collecting and understanding customer feedback over the years?
So here's what's so interesting. So DC was our first licensed market, but Arizona was our first operating market.
Oh,
And so,
interesting.
so,
Yeah.
so, and we could have never predicted how that evolved. But we actually opened in Tempe, Arizona first.
Okay.
And I remember when we opened and all of the things we were learning in Arizona that then we were able to apply in DC. But one of the first things we realized is that there was actually a much different consumer base than we had expected. And I'll give you a funny anecdote.
Mhm.
So I remember when we opened up in Tempe, and I'd seen all of these videos on the news from Colorado where you have lines around the corner. We weren't sure what to expect, but it was the middle of summer in Phoenix, which is, it's a tough spot to be. It was about
Yeah.
125 degrees outside in
Oh,
the shade.
goodness.
So we opened up, and lo and behold, no one was there. It was completely empty. It was a ghost town, and I was sitting there on my laptop, sort of wondering how to debrief the board and investors about our first open day. And two gentlemen walked in, and they were incredibly polite, and they had their proper ID, and we checked them in, and they were in the waiting room with me, and they looked at me, and we had a chat. And what was so funny is that they both had tattoos one on their neck and one on their forehead, MS-13. So I'm not
Oh,
sure. I'm not sure if they were members of MS-13, but I'm not sure if you want to have that tattoo unless you are. But they couldn't
right.
have been more friendly. And I asked them, hey guys, how are you doing today? And they said, how are you doing? We said, fine. And we had a nice conversation, but I remember thinking to myself, like, this is not who I expected to walk in first. I didn't know who to expect, but I
Yeah.
wasn't expecting that. You know, the next person who came in was a gentleman who's actually pushing his uncle in a wheelchair, and the next person that came in was a grandmother of four. And then, you know, and then so what I realized very quickly is that it's not a single purpose use, right? It's not a narrowly defined category with a narrowly defined consumer base. It's everybody. It's everybody who's experienced pain or anxiety. It's everybody who has these sort of these illnesses or these symptoms that they're trying to address. And so we were able to take that information and
Right.
sort of take that into the DC market. Now, what made DC so interesting is that DC actually had a much more narrow field of qualifying conditions. So to your point, what we began doing at that point is aggregating the information that we were able to aggregate with patient consent or consumer consent and trying to figure out who it was we were serving so that we could develop better products, we could develop better services and better infrastructure. And you know, lo and behold, the first survey that we performed was in DC. And what we learned, first formal survey, and what we learned is that over 56% of the people we were serving in DC at that time were HIV positive. So it's not that there was just this amorphous group of people that didn't have a discernible qualifying condition. They absolutely had a qualifying condition, and it was very severe. And what we've also learned is that most of those consumers or patients were using our products as a substitute for benzos and opioids, which, as you know, are the two most frequently prescribed meds for long-term survivors of HIV. Then we learned that they were saving between $50 and $150 a month because they no longer had to spend all the money on copays to buy their prescription meds. So they were actually
Wow.
saving money even though our products were out of pocket. And then what was really fascinating, and this is not clinical in nature, but it was you know, as the population increased, now we have millions of peoples of information in this HIPAA compliant database from all around the country. At that time, 93% of the people who we asked said that our products worked better for their symptoms than the standard of care. And that to us was really amazing because what it told us is that even in the context of a medical condition, and I know the market is moving towards adult use, but I think it's a bit, it's disingenuous to assume that the adult use market doesn't include a significant number of people who are using cannabis for a health and wellness application.
Right.
And when we look at our data, and we look at what we've learned, the reason why is because we saw that trend line developing over time across the country. And so, you know, that's what's had an impact on the way we develop our pricing structures, the new brands we're rolling out, the products and the form factors. All of those things were driven by the data, and as we've grown, that data has become even more important because it not only tells us what to do in a health and wellness setting, but it also tells us what to expect as these markets transition from medical to adult use, because that's another sort of seismic change in the marketplace when that happens overnight.
Yeah, interesting, interesting. Now, when you know, you guys weathered you know, these early beginnings, you know, really pioneering the field being so, with the industry being so new, you know, once you've got that sort of taken care of, how did you approach the process of expanding into other states? You know, how did you go about choosing the markets you wanted to go into and the method of going into those markets, you know, whether it be applying, you know, for those markets or maybe partnering with somebody? Tell us about those decisions.
Certainly. So we had partners in a number of markets, but for the most part, the decision to apply for new markets, and we built the business organically. Up until recently, we'd never acquired an operating business or even announced an acquisition of an operating business, and that changed last year with the announcement of the Colorado transaction. But the every other market that we're in was basically a ground build. And so what happened was I actually moved from New York to DC to sort of oversee the DC process. And then when we started building out in Arizona, I moved from DC to Arizona. I would go back and forth, and I moved from Arizona to Massachusetts, from Massachusetts to Illinois, from Illinois, so on and so forth. And as we grew, like nowadays, I don't have to travel nearly as much, but at the time, I was just living on the road. And what we did is we set up criteria. And the criteria was simple. We wanted to approach medical markets that had large sort of domestic or sort of, let's call it captive marketplaces within those markets. We liked the limited license environment for a variety of reasons. But we also wanted to make sure that we could be fully integrated, because being fully integrated for us was important. So we had supply chain continuity, so we had quality assurance from top to bottom, and so that we would be able to really drive the economic value and build an internal skill set. Because what we found is that when we bring on new colleagues into the organization, people like to transition from one side of the business to the other to learn about it, because it's a really, how many times does someone in the agricultural sector or someone in the sales sector get to basically, cross over into manufacturing and vice versa, and basically play around, and then that gives people a lot of opportunities for upward mobility and career progress, to really ascend the title structures. So we had a formula that we were a framework that we were trying to follow to determine which markets we would pursue. And then we had basically a very limited team and very limited resources, and we used those and stretched them as much as we could. We didn't hit everything. We won some, we lost some, but we won more than we lost, and that became the foundation that Columbia Care was built on.
Mhm. Got it. And now, when it comes to these applications, what in your mind makes for a strong application? I mean, or let's put it this way, a winning application. Like, it sounds like there's a lot of strong applications out there. How
Yeah.
does a winning application rise above?
You know, um, it's a very good question. I think that um, we have often written our applications, or I have written our applications, not, and we have a team now that does this. But they write the applications in such a way that we know that we can deliver what we commit to. And I think the most difficult thing about the application process is that in each market, generally speaking, you have a lot of people who may not be as familiar with the sector and the requirements of an operating business in the sector. And so you have people. I remember in some states we competed against somebody that said they were only going to hire, members of the SEAL teams to provide security, and that's just not realistic, and it's not even appropriate, but it's not realistic, right? But if you're a young regulator who's reading this for the first time, would you rather have someone who's using sort of a for-hire security service, or the Navy SEALs? I mean, it just sounds better. And so we often saw ourselves competing against people who were making unreasonable claims, and they were being awarded licenses as a result. But for us, a winning application is one that is rooted in truth and experience, and that's not always what people want. So, for example, now that we're viewed as one of the largest companies in the United States, in some markets that's viewed as a detriment, right? Where the regulators really want somebody local to run those businesses. And what we found, unfortunately, is that the more experience you have, the less mistakes you make. And so that that kind of academic approach to the awarding of these licenses sometimes leads people down a very unconstructive pathway. But I would say there are exceptions to every rule. So there's no magic. You just have to be very thorough and very careful. And frankly, there were ebbs and flows. I feel like at the beginning we had a great set of applications. We were able to leverage the experience and that we had, because it was a unique asset at that time. I think we probably stopped investing for a brief period into the quality of those applications, and I think our success rates dropped as a result. But we've sort of learned that lesson, and we've always made sure that we continue to maintain and upgrade the materials that we present to regulators so that they can make informed decisions.
Interesting. Yeah, I was wondering, as the industry matures and as companies mature, do you find the applications themselves, the paperwork that you guys have to fill out? I feel, and I feel it's an injustice to call it just paperwork, so I know it's a lot more than that. But these heavy-duty documents that you guys have to fill out, do you feel that the regulators are getting better about that? Again, I recall the requirements you guys had to deal with in DC and some other early markets, and they just made some unreasonable requests that make it hard. Has that aspect of applying changed, where the regulators who are writing the application forms, their requests are more reasonable, or is that not changed?
I think in general they've become more reasonable, but you always have outliers, and I won't point fingers at anyone in particular, but in some markets you have governors or legislative bodies or legislative leadership where they're not supportive of these programs, and so they direct their teams to be as rigid as possible, and that makes it hard to operate. I think it's a good discipline, but it's we prefer relationships where we can really maintain a fluidity, and we can maintain a discourse, so that if we run into problems or concerns, we can voice them and sort of say, hey, listen, I know we would like to do this, but in order for us to get there, we're actually going to have to take 4 steps that are completely different than the ones we told you.
Hmm.
And so being able to engage in that type of dialogue is really helpful. But I think the one thing that is true across the board is that regulators have learned from one another, and they are very, very active in dialogue with one another. So, especially during COVID, as an example, you had a couple of states that were natural leaders in the field. It's establishing sort of best practices, and those became the precedents that other regulators were willing to follow. And that was
Hmm.
important because those decisions and those regulatory, that, let's call it that courage, that sort of regulatory insight, what I think saved the industry. Because I think if we hadn't been able to participate throughout COVID, you could have been, many, many, many more businesses would have failed. And the survival of the industry requires the survival of a lot of operators, not just a few.
Now, you guys have also formed partnerships in various states, if I recall correctly, with a delivery company in New York and some other examples. How do you guys go about choosing, who to partner with, when to partner, that kind of thing? When do you find partnerships valuable?
So we try to be as self-aware as possible. There are certain things we think we're pretty good at, and there are certain things we know we're
Fro-
not good at,
uh,
and there are certain things that we'd like to be good at. But we're not. I think we built an organization that really embraces skill and talent, and being able to sort of look at oneself in the mirror and say, we're just never going to be as good as they are at doing what they do. Now, if we could bring that skill onto our platform and we could somehow combine forces, then we could be better together. As long as there's an alignment of interest, and as long as there's a level of sort of professionalism that sort of that moves from one entity to the other. And so we've looked at partnerships from a variety of perspectives. Sometimes as a way to sort of help others, other times as a way to help ourselves. But there's always a very sort of specific reason why we do what we do, based on our longer term strategy, and that is to be the best operator in the space and the most efficient and frankly the best deliverer of value to the communities and people we serve.
Got it. Okay. Now, one of the issues that I also wanted to explore was funding. In 2019, Columbia Care listed on the NEO exchange in Canada, and I believe in March, you all listed on the CSE as well. And you've also obtained funding through the debt financing method. So tell me, I guess first, maybe starting with the public listings, when you guys decided the time was right to do that, and how you've leveraged being able to do that, and then also how a company might go about obtaining capital through debt financing.
Certainly. So I think that we whether it's a good thing or a bad thing, I don't know, but we actually went public right around the peak of the market, and so
Mhm.
the equity markets were very interested in high quality cannabis companies. So we weren't the first, but we weren't the last. We chose a slightly different method than most other companies that went public. We did not go public through an RTO. We actually used a reverse merger into a SPAC, and as a result, there was no marketing process. So the board made a decision on a Tuesday, and by Thursday, we'd had indications, north of $280 million. We ended up raising about 115, so we obviously didn't take as much money as we could have. But the uh, uh, the the process procedurally was very straightforward. Now we chose to list on the NEO because it was a senior exchange, and
Mhm.
because it was the only exchange that allowed a SPAC process to take place. The CSE didn't have that capability at the time.
Interesting.
But the senior exchange for us was important because it allowed us to sort of maintain the narrative with our investors that basically said, hey, we have a regulator, we have an exchange that enforces regulations and oversight, and as a result, we have more checks and balances than our competitors. Now, the drawback was that the CSC had more companies that had listed, that U.S. cannabis companies had listed on it, so it was a more familiar marketplace than the NEO. So what we ended up doing is dual listing, so with our primary listing on the NEO, also making our shares traded and available on the CSE to enhance volume and enhance just basically visibility into the retail trading markets. I would say that the equity markets, even today, are still fairly challenged. It's a little bit about the haves and the have-nots, and I think that translates into the debt markets too. We did not leverage the balance sheet. We still only have about $40 million in debt, on a $700-800 million market cap company, and we chose that pathway because we're at the point where we are actually crossing over into positive territory on a consolidated basis. And so we have a sort of a transition point where we can justify leverage because we'll be able to pay for the coupon, but we wanted to maintain liquidity and have strategic flexibility without diluting our shares. And unfortunately, like everyone else's, our shares have gotten a little bit beaten up since they went public. But I think you've started to see a stabilization now. And I think what's even more exciting is that with the extra liquidity from the debt markets, we now are in a position where we have a very, very high quality and very cash rich balance sheet that allows us to participate more so in M&A than we have in the past, which we intend to do. Now, if I were looking at the marketplace from a small operator or a startup today, I would always defer to the equity markets, even if it's dilutive, first. And I'd say that because debt is wonderful until it's not. And you have to, being able to maintain a financial profile that is self-funding, so where you don't have to rely on the markets to bail you out if you have maturity coming. That's the only thing that can really kill your company is tail risk. So equity may be more expensive, but it allows you to live to fight another day if something goes wrong. And unfortunately, as we've all learned in 2020, something goes wrong every day. Whether it's whether it's the sky is falling, or you've got pandemics, riots, I mean, you name it. And so we've been very, very conservative, and I'd like to think that long term will pay off. And now what that's also done is it's sort of slowed down our growth so that we're more operationally focused, where we don't have integration risk with huge transactions that we've announced but not yet closed, or have closed that you have yet to integrate. We don't have sort of significant maturities on the horizon that we have to worry about. So what I spend my time thinking about is strategy and tactics. I don't worry about sort of operational hiccups, and I don't worry about tail risk associated with high degrees of leverage. And I think that's a really nice source of freedom for me, because when we think about what we can do, we can always add more leverage. We can always sort of raise equity, and we've done that, right? We just actually did a convert and a debt offering. Our debt offering, I think, we began accepting capital the day that the Dow fell the most it has in its entire history. So what that tells me is that institutions, and by the way, these were all new, and many new institutions participated in both of those financings. So we're now beginning to see new, sophisticated institutional investors come into the market and look at individual companies as opposed to just the sector. So that I think everyone's comfortable that the sector is doing well, but now they're looking to pick and choose their spots. I love the fact that we have been able to find, and institutional investors have been able to find us to sort of make sure that we maintain that reputation as being kind of conservative, but very thoughtful and very methodical, and frankly, able to capture all the upside without a lot of the tail risk. So, for us, it's been a really sort of enlightening period, because I would have never presumed to have been in the position that we were in. But when we raised that money, everyone said, "There's no way you're going to raise it." We did. And then we went out and actually the reason why we did the convert is because a couple of investors said, we really would rather own your equity than your debt, but if you're out there and you do a convert, let us know. And so one investor was the anchor and did over 50% of about 50% of the debt offering. And one investor did about 50% of the convertible offering. And the convert was priced at a premium to the marketplace, and it was a 5% coupon, which is fantastic cost of capital. And so we priced it at 20% premium to the I think it was the average 20-day average trading volume. And so it was a really fortunate sort of affirmation that I can sort of go in and hang my head high, because at this point, if we execute, which we seem to be doing just fine, and if our margins continue to improve, which they have been, we don't really need to go back to the market unless we
Mhm.
have a strategic transaction we need to finance. And that's a great place to be. So if I were looking at the world, I would still say take the dilution, raise the capital, and raise the capital when you can.
Mhm.
May not be perfect terms, but you're never going to get perfect terms. And the idea is that there's such a big opportunity, such a big industry, and such a big structural change to a huge part of the economy. As long as you participate, the rising tide will raise all ships.
Now, I think if I heard you correctly in your answer, you were talking about how Columbia Care would like to step up its M&A activity, I guess, in the near future. Can you tell us a little bit about that? Why you think now is a good time? What kind of businesses you might be looking to acquire? That kind of thing.
Well, I think this goes back to the point I touched on earlier, which is we try to be self-aware,
Mhm.
and we know what we're good at, and we know what we're not good at, and we know what areas where we can improve. And so we now are in a market where the equity markets are very, very difficult, and a lot of companies that thought they might be able to go public or raise capital may have a difficult time doing that. But they can look at us and say, "Look, here's a company has a great reputation. We compete against them." So we know how they operate. We know that they're ethical. We know that they're very high integrity, and we know they run a good business. And so they can see our business from the inside because they're either a competitor or a vendor, whatever it may be, in one of our markets. And we have the same insight into them. And so we're actually seeing a lot of very interesting discussions with people who we have a deep amount of respect for in existing markets that allow us to flex into those markets and really
Mhm.
sort of dig in and expand our leadership positions. And so, for us, because we have cash, because we have a stock that's actually fairly valued, whether I like it or not, we do trade at a pretty significant discount to our peers. And
Mhm.
so, and once we transition into EBITDA positive territory, it's reasonable to expect that our multiple will kind of normalize. So
Mhm.
all of these things are happening at a very interesting moment in time when valuations have collapsed and the markets, the financial markets have been very challenging to raise capital in. So we can solve a lot of problems for partners, and they can solve problems for us too. So we're looking at tuck-in acquisitions across the country that can really help us leverage the businesses that we want to grow and really give the people who we've empowered to lead these businesses the resources they need to succeed and win.
Okay, that's int- um, that's interesting. Now we got a couple more minutes here, and I wanted to before we have to sign off. I wanted to ask you about the a lot of the medical partnerships or medical work that Columbia Care is involved in. I know you guys have partnered with Mount Sinai Hospital, New York University Medical Center, several other places. Tell us about how this sort of high level medical cooperation with high level medical institutions fits into Columbia Care's larger strategy.
So it helps us in a number of ways. From a consumer product perspective, being able to say that we've tested our products and tested our excipients and tested our manufacturing standards with some of the best academic medical centers in the world, and I think it's a very important thing to say, right? It gives us confidence that we say our products are the highest quality. There's just no debate, and that matters. And I don't care if someone's a medical consumer or adult use consumer. People are buying a discretionary product, and they deserve to buy the highest quality, and that matters a lot to us. But then on the medical side, I think now that sort of these markets and many of our markets, and I think 8 or 9 of our markets are expected to transition from medical to adult use in the next 24 months.
Yeah.
So with that happening, you're going to see a massive, massive influx of adult use products and adult use brands and adult use everything, and adult use consumers. But that doesn't mean the medical market goes away. It just means the medical market may be smaller than the adult use market. It may be but it's still an important subset. And so when we think about, let's call it 3 or 5 years out, not only do I need to be able to validate the statements we make about the quality of our products, and I need to push us to be more innovative to come up with new form factors on the consumer product side. At some point, based on the data that we have gathered, insurers are going to look for national counterparties to provide their patients with access to medical cannabis products. And so the studies that we enroll in today or participate in, very inexpensive. They're very regimented, meaning their expectations for quality is second to none. But it positions us so that when the payers finally decide to start reimbursing for medical conditions, there will be a very, very small number of companies that qualify because we'll have the safety data, we'll have the efficacy, sort of the observational efficacy data, and the FDA has come out and said that, a clinical trial is always the gold standard, but observational data with a large population is also incredibly important. So if we can we can prove to somebody that, in New York, 12 million doses of our products have been administered. We've had, no adverse events, right? If we can show that, in a cohort of neuropathy patients, 68% of the people who used our products either showed an elimination, a reduction, or stabilization in their use of opioids. Right? That's a big deal. And by the way, our products are not only a lot safer, they're a lot less expensive. So we can save the system money, we can improve people's lives, we can eliminate that tail risk for patients. Right? That's the holy grail for us. So it helps us fulfill our mission of improving other people's lives. And by the way, the reason why people buy Johnson & Johnson Q-tips is because Johnson & Johnson, makes monoclonal antibodies, and they're sort of a healthcare company. So there's a real consumer angle from a branding perspective and from a notoriety perspective that we think matters, that has a halo effect. And so we're very proud, and we want to continue to emphasize that unique expertise and the unique product offerings and the uniqueness of the data we have, especially in the context of reimbursement. But we continue to leverage that into the consumer product space because people come to us for a reason. They come to us because they believe us. They come to us because they get a differentiated experience. And they come to us because, there's a reason why if you go and you're going to buy an iPhone, if you go to the Apple store on Fifth Avenue, there's always a line. But if you go to the AT&T store 1 block away, there's no line. No one buys their iPhone at AT&T. Why? Because, candidly, the service is not that good. Yeah. People don't know their products. There's nothing to say. But if you go and talk to someone at the Genius Bar, 9 times out of 10, you come away feeling better, smarter, and more confident in the products you have. That's the component of what we deliver through our dispensary network that's national. But we can say those things because we have the data and the products to back them up. And that's what makes it such a unique combination.
Interesting. Got it. Okay. Now, I want to talk a little bit about, future markets. As we mentioned at the very top of the program, you all have a license in the European Union. So I wanted to ask you what kind of opportunities you all see in the EU. And then also, if we could round it out, what new markets or potential new markets in the U.S. you think might be interesting?
Well, I think that the U.S. market is still our focus, and we, as I mentioned, we have so many, 8, 9 markets that are transitioning from medical adult use, and what that means is that I have 8 or 9 markets that are going to increase in size overnight by 3 to 5x organically. So being able to sort of provide the resources necessary to capitalize and to basically deliver on the commitments we made to our communities in that environment is a pretty tall order. Europe is, everybody knows that if you want to if you want to have a sustainable business, you really have to be in the United States. Mm-hmm. And Europe is quickly changing, and it will continue to change. We have OTC, hemp-derived CBD products for sale in Europe, in the UK, and in continental Europe. We also have RX products, so actually physician-recommended medical marijuana products being sold. And so that's a market that we are in. But it's a future market, right? It's a 3 to 5 year market, because for the next 3 to 5 years, the U.S. is going to have us pretty busy, and it's going to be the market that defines the rest of the world from our perspective. And unlike the European markets, there's no doubt that in the U.S. you're going to see this transition from medical to adult use continue and become a national theme that materializes fairly quickly. So we're not taking our eye off the U.S. ball, and every single market that's transitioning from medical to adult use is an emerging market, right? Because you think about, you walk into to work on a Tuesday and you have 1 patient. You walk into work on a Wednesday and you've got 5, right? Now multiply that by tens of thousands in each of our markets, and all of a sudden you've got a real logistical opportunity sitting in front of you. I just don't see that happening in Europe anytime soon, but we still think about the business on a 1, 3, 5, 7, and 10 year time frame when we talk about our long-term strategy. And so it's important for us to establish credibility with the regulators in Europe and to have a footprint there. But we understand that's an investment for the future. It's not necessarily going to drive value today.
Got it. Okay. Last question here. The election is not too far away, and people are talking about federal legalization. Probably still seems a ways off. But when Columbia Care thinks about long-term strategy, do you guys factor in what things might look like should federal legalization happen?
We spend a lot of time thinking about all of those topics, and our it's so difficult to sort of prognosticate and predict. And so the one thing I would say is that I feel, and this is an odd thing for someone to say, it's also self-serving, but I think it is true. Um, Heads we win, tails we win. So if Trump remains president, we're going to continue to see the states take action and evolve. President Trump has said that this is not his issue, and if Congress approves the SAFE Act or one of the stimulus packages, it'll get approved. So I actually think that there is the closer the race, the more incentive the Republican Party has to sort of push something through on the cannabis side, because it is a reason for people to come to the polls. Now, the flip side is that you've got Joe Biden, who's inherited a lot of the Bernie Sanders people who just want to wholesale legalize. Legalization happens. That doesn't eliminate the rules and the laws and the regulations that exist at the state level. It just means that we can now use the banking system. We can now list on the NASDAQ or New York Stock Exchange. We can now get loans at a normal cost of debt, so we can refinance the $40 million of debt we have outstanding. And by the way, it also means that all the big mutual fund and institutions can now begin to invest in our sector. So you think about the trillions of dollars that are sitting on the sidelines right now that are looking for high growth, high margin opportunities. This is it. So, and all the strategic conversations that have yet to happen. So there is a real, there's an asymmetric outcome here that's skewed to the upside. And I think that the people who are ahead of that curve are going to get rewarded, because, we've all seen what happens in the market when big money starts to come in. We've all seen what happens when strategic players start to come in, right? As good as we are, there's a good chance that many of the large companies in the cannabis sector today get gobbled up by larger companies. But in the meantime, there's real opportunity to create careers and to be innovative and to do an incredibly good thing for the communities we serve. And at the same time, we can do well, and we can do well by our shareholders. And that to me is a really important nexus, which is we've got to do well by doing good. And I think that's exactly one of the few things that the sector can do extraordinarily well relative to any other sector.
Excellent. All right. Nick, that's about it. I really appreciate your time and insights with us this afternoon. It's been a great help, and many thanks, and best of luck to you this year. I hope, people can do as well as they can in 2020. I'm not sure what to wish.
Yeah. Well, thank you very much. I appreciate your time.
Yeah, thank you again. And much appreciated. Till next time.
Great to talk to you. Take care.
All best.
Bye-bye.